as that growth rate comes down relative to previous quarters, it starts to weigh on that earnings growth to the extent that Amazon is relying on advertising to produce that. So, they've kind of reversed course on the profitability of the business. And I think the slowdown in advertising is a big reason why.
Hey gang, it's Wednesday, May 11th. Andrew and listeners, welcome to the Behind the Numbers Daily, an eMarketer podcast made possible by mParticle. I'm Marcus. Today I'm joined by our principal analyst on the retail and e-commerce team. It's Andrew Lipsman.
Hey, Marcus.
Hey chap, today's fact. We have a new host. That's today's fact. We welcome in Sarah Lebo, who is one of our analysts at the company. She will be hosting the new Reimagining Retail show. Sarah, welcome to the podcast.
Thanks, Marcus. Happy to be here.
Yes, indeed. So tell us about the new show.
Yeah, so Reimagining Retail will air every Wednesday starting May 18th. The show is about how retail collides with every part of our lives and what's around the corner. Andrew and Susie are still going to be around, but they'll be sitting across from me as guests while I am in the host chair.
Perfect. And Andrew, you're going to be on the first episode of the newly reformatted show. What will it be about?
Yes, and back in the guest chair where I'm most comfortable. We're going to be talking about D2C brands. I just finished up my report on the topic a week or so ago and look forward to chatting about it with Sarah in more depth.
Excellent. Well, Sarah, thank you so much for stopping by to say hello. And again, welcome to the podcast.
Thank you. I'll see you next week.
Yes, indeed. Tune in May 18th to hang out with Sarah and the retail gang, starting with Andrew talking about D2Cs. But today's real topic, Amazon's Q1 2022. Andrew, we're talking Amazon today, as the title suggests. We're going to talk about how they did in the months of January, February, and March. We're going to talk about buying things on Amazon.com. We'll talk about buying things in Amazon-owned stores, buying ads from Amazon, and other ways that they make money as well. What do we expect to see from them in Q2? That will make up the first half of our show. Let's get to it. We'll start with a top-line number. Total net sales hit $116 billion. That'll be up 7%. Last Q1, they're up 44%. So that's pretty telling. Let's move to a couple of line items with regards to buying things on Amazon.com. Andrew, number one, most of that $116 billion Amazon made came from selling things on Amazon. But that $51 billion they made was down 3 points on last Q1. Its first quarterly loss since 2015, and its second consecutive quarter of negative growth. The second thing here is 22% of that pie that Amazon makes comes from third-party seller services. That was up 7%, but 9 times slower growth than last Q1. Andrew, we're pretty used to seeing stellar numbers from Amazon. What the hell's going on here?
Yeah, it feels a little bit weird to say that on a quarter of $116 billion in sales, that it was a pretty tough quarter. Maybe the worst one that I can remember. But, it's part of a broader theme here. So I don't think Amazon is alone, but there is definitely a slowdown that's happening in e-commerce. So Amazon's taken a bit of a haircut. Now, you mentioned last year's Q1 was growing at over 40%. So the comps, right, the year-over-year comps are a big part of the story. So we do need to calibrate a little bit with respect to that.
Good point.
And, this quarter in that regard will be especially tough. Will probably be the toughest one for Amazon this year. That said, there's a clear softening. We're seeing more of the activity or proportionally more activity moving back into in-store channels. So given that Amazon's about 40% of the e-commerce market in the US, it was a tougher quarter.
Mm-hmm. Yeah, and it's been tough quarters in terms of online store sales. Most quarters this year, Q1 was 44%, but then it was 16%, then it was 3%, then it was negative 0.6%, and then negative 3% as well. So yeah, when you're looking at comps, that's a really good point. What do you point to the most with regards to why things are slowing down for Amazon? I mean, you've got some generic things that are happening in terms of affecting all retailers, supply chain issues, higher fuel prices making delivery more expensive. You've got just overall consumer spending. Karen Weiss of the New York Times noted that according to the Commerce Department, consumer spending on the kinds of non-durable products that people often buy on Amazon was down 0.6% in Q1 year on year when adjusted for inflation. You've also got Amazon increasing wages to try to attract staff in the face of labor shortages as well. They could also face increasing costs with regards to the attempts by warehouse employees to unionize. and just a ton of investment for Amazon. They're spending not just on hiring, but also trying to double the size of their warehousing infrastructure in the last 2 years. Where do you put most of the blame in terms of this slowdown, or is it somewhere else?
Well, Amazon's not alone in this, but there's a lot of blame going around in quarterly earnings to, we'll call it the acts of God, or things outside of CEO's control, war in Ukraine, supply chain, all that stuff. I'm not going to say that those things aren't playing a role, but that's not the driver. Those are not the driver of these trends. The driver of the trends is fundamentally the comparisons and the fact that we're just normalizing coming out of the pandemic here. So we have 2 years of really choppy quarters. And I think that throughout the pandemic, it was often miscast as a permanent acceleration in e-commerce. I don't think that was true. By and large, I think there are some small slivers of e-commerce that have been permanently accelerated, mostly on the grocery side of things. But broadly, we're just kind of moving back to the previous trend line of e-commerce penetration. And so as things normalize, we're settling back into that previous trend line. And it just means that the comps are wrong. Now, did the market get overly exuberant about e-commerce companies in the run-up that we saw over the last 2 years? Yeah, absolutely. I just think this is the normal course of business and something that we frankly should have expected to happen as we got into the kind of waning period of the pandemic.
Yeah, part of this is just the market as well. Overall inflationary expenses adding $2 billion in costs, Amazon says. But we've also seen a kind of an evolution of the supply chain over the last couple of years. At the start, it was just trying to keep up and get things to people because everyone did move to buy things online. Andrew, you've noted that Amazon may have built too much in terms of capacity.
Yeah, but before I get to capacity, let me talk really quickly about inflation, just because that does loom large in terms of affecting consumer spending. It's going to be a growing issue, but what's interesting is that we haven't seen huge slowdowns in consumer spending just yet. The overall levels in consumer spend are still pretty elevated. Consumers are getting less for their dollar, for sure, but the overall spend levels are still pretty elevated. We'll start to see more of that probably if these inflation numbers stay high over the next couple of quarters. So Amazon will start to feel more of a headwind on that front. We're not quite there yet. As far as Amazon's overbuilt capacity, well, listen, they had already been ramping up prior to the pandemic to grow their capacity to get to next day and same day shipping. And then they accelerated that given the needs of the pandemic and, probably factoring in some permanent acceleration that may not be there. So now they're getting to a point where they're a little bit overbuilt. I think that there are a couple things that means is that they can start to fulfill that promise again on next day and same day, that the logistics are there to be able to kind of work their way out of the capacity constraints that they might have had during 2020 and 2021. I also think that this is maybe going to allow them to play some offense in a way that they haven't in the last couple of years. And specifically, what I think is much more likely now that they have this overbuilt capacity is we could see a second Prime Day this year. So we know that the first one's going to happen, midsummer, looking like that, maybe that second week of July. I think we're also probably going to see one in October like we saw in 2020.
Interesting. Okay. Because, they're moving it. So from June to July, that moves it from Q2 to Q3, which explains why they're a little bit more pessimistic about Q2. But interesting to note from you that you think there could be another one added. You mentioned the next day and same day and trying to ramp that back up. It seemed like there was a race of sorts that Amazon was way out ahead of in terms of trying to get things to people as fast as possible. And it used to be, 5 days was fine. And then it's 2 days for a long time. And then it was next day. Do you think that people are going to have those expectations again in terms of getting things to them quickly? Or do you think that because the pandemic made them a bit more understanding in terms of, there's lots of people buying lots of stuff, I can wait an extra day or so for that thing? Do you think that expectation is going to be there in terms of customers wanting stuff at the speed of light?
Ultimately, yes. It's a rubber band effect, right? Consumers did get a bit more tolerant. They understood the constraints that, prioritization of essentials and in 2020, things of that nature. But, the consumer has ultimately a fairly short memory and they kind of get used to whatever they've been experiencing for, let's say, the past 6 months. So as delivery times have normalized quite a bit, that's their new reset expectation. So to the extent that Amazon can keep pushing that forward and getting closer and closer to, next day and same day consistently, that's going to start to set their expectations going forward.
We saw them put the price of Prime up a few months ago from $119 to $139. It's a membership program that pretty much half the country is part of. And a big reason for that is because of the speed at which people can get things delivered, despite all the other perks that you get with that. They just recently announced a Buy with Prime initiative, which I find fascinating. I have a bunch of questions on this, but what is this and what's your initial take on how this could or could not impact retail?
So this is another news story that I thought there was a lot of exuberance on behalf of how impactful this could be for Amazon. I think it's a smart move for Amazon. I just don't think it's going to be a game changer by any stretch. So it's being marketed in many ways towards D2C brands. So these are the brands that traditionally have resisted selling on Amazon. They don't want to cough up those margins to Amazon and be reliant there. So they've actually, in most cases, made that active choice. Now, do I understand why Amazon wants to court that market? Yes, they want better brands desired by consumers, and they want to align themselves with a part of the e-commerce market that's growing faster than they are. When, Amazon's sweet spot tends to be more everyday and commodity type of items. The ones who are more likely to use Buy with Prime are going to be sellers who are already running, a parallel strategy selling on Amazon. It's easy for them to add that button, and basically because they're already selling through Amazon and relying on that infrastructure, it takes away some friction. So it could boost some sales, so I think there is going to be some impact. I just don't think it's going to be a substantial impact.
Okay. I find the move really interesting. I'll reserve all the other questions I have maybe for another episode because I want to get through some of the other line items that Amazon reported. Let's stick with buying things for a second. Buying things from Amazon-owned stores, though, so in-store sales. 4% of the money that Amazon makes comes from its physical stores. Growth was up 17% in Q1, the highest it's been in years. Last Q1, 2021, it was down 16%, the lowest that we've seen it, at least for a very, very long time. So, Andrew, a bit of a turnaround in the physical stores. What do you make of this?
Some of it's a rebound effect as more foot traffic has returned to stores. It's still mostly Whole Foods, but Amazon is starting to add locations of Amazon Fresh. This is basically a no margin business for them today. So I don't think it affects their numbers one way or the other. But as we look out a couple of years and assuming that Amazon's going to start ramping up Amazon Fresh to the hundreds and hundreds of locations, it will start to be more meaningful.
Okay. Let's move to buying ads from Amazon, something that still sounds a bit odd, even though Amazon is a significant player in this space. In Q4, the company broke out Amazon advertising for the first time, calling it advertising services. In Q1, this line item made $7.9 billion, basically $8 billion, up 23%. That is 7% of all the money Amazon made in the quarter. Other, which used to include Amazon advertising, but now doesn't, only accounts for 0.6% of the total money the company makes. So we're talking about Amazon advertising now, which used to live within other and now broken out. Andrew, your thoughts on the $8 billion that they made, up 23% in Q1?
On the one hand, it continues to be looked at as a bright spot, nothing to sneeze at, nice growth rates. Yeah. Growth rates that are running well ahead of the growth in the commerce business. Those two things do kind of move in conjunction with one another, and certainly outperforming other big digital advertising companies and different digital ad formats in terms of the growth rates. That said, those growth rates have come down quite a bit. I mean, if you go back in time about 1 year, Amazon had a series of quarters where that number was running at 60, 70, 80% growth rates. And as they did that, their profits were going through the roof. So as that growth rate comes down relative to previous quarters, it starts to weigh on that earnings growth to the extent that Amazon is relying on advertising to produce that. So, they've kind of reversed course on the profitability of the business. And I think the slowdown in advertising is a big reason why.
Yes. Yeah, the growth in advertising services in Q3 of last year was 53%. It then went to 32% in Q4, was 23% this quarter. So it has that downward staircase trajectory. But in Q1 of last year, it accounted for 6% of all the money Amazon made. This quarter, it accounts for 7%. So it is a growing share very slowly in terms of the total money Amazon makes. Other ways Amazon makes money, Andrew, nearly 16% of its revenues come from AWS, Amazon Web Services, up 37%. This is the highest line item growth by a long shot. That's over $18 billion they made from AWS in Q1. It was a quarterly record. And also 7% of Amazon's revenues come from subscription services. So the same share pretty much as they make in advertising. 7% comes from subscription services. That was up 11%. Your thoughts on the other ways Amazon's been making money?
AWS continues to be the big story there because it's a pretty big slice of revenue and hugely profitable. It had been on a tear over the last, year and a half in terms of continuing to accelerate its growth rate. That finally reversed course by a couple of percentage points. But I will say they managed their expenses better. So the profitability actually was really good. So I still think that continues to be probably the biggest bright spot of the business over the last couple of quarters.
Mm-hmm. Amazon expecting an uninspiring 3 to 7% growth in Q2. Part of that reason, Andrew, we've already discussed, is that Prime moves to July, it moves to Q3. But outside of that, what do you make of what we should be expecting from Amazon in April, May, and June?
I think Amazon and other smart companies do this. When you have a tough quarter, it's a good chance to set a low bar so it's easier to clear that hurdle in subsequent quarters. So I think they're playing it a little bit conservatively. That said, I also feel like Amazon is kind of shrugging in a sense that they don't really know what to expect in coming quarters because the comps have gotten so odd. It's not just comping against last year. You almost have to then go back and comp against Q2 from 2 years ago. So there is a lot more uncertainty, and I think that may be part of it. But don't be surprised if Amazon ends up posting a much better quarter than they're currently guiding to. Yeah.
Q2 of 2020 was for net store sales was 47%. Then Q2 last year was 16%. Numbers are all over the place, so I don't blame them. That's it for the lead time. Now for the halftime report. Andrew, what's your takeaway from the first half and an overall grade for Amazon's Q1 performance?
Oh, overall grade. So I'd have to give Amazon probably a C for this quarter. Ooh. I almost gave them a D+, but I thought that would be a little too harsh, even though it is probably as weak of a quarter as I can remember for Amazon. That said, my takeaway is because it was not a great quarter and because Andy Jassy is still pretty new to the job, don't expect Amazon to take this line down. I mentioned a prediction of Amazon doing 2 Prime days. It's a big reason why. I think that they need to recharge that commerce side of the business because of how it impacts so many other aspects of the business. So don't expect them to take these last couple quarters lying down.
All right, it's time for In Other News. But first, a quick word from our sponsor, mParticle. At the end of the day, your customer has to be at the center of everything you do. This starts with the right customer data strategy as well as the right foundation to solve the challenges that typically inhibit success, such as data quality, data governance, and connectivity. mParticle is your real-time customer data infrastructure that helps you accelerate your data strategy by cleansing, visualizing, and integrating your customer data from anywhere to anywhere. Ultimately, better data leads to better decisions, better customer experiences, and better outcomes. See why the best brands choose mParticle. Go to www.mparticle.com. Folks, we're back. Today in other news, Walmart offering deeper gas discounts, and what is Target's strategy to compete with Amazon? Story 1. Walmart is offering deeper gas discounts in hopes to drive folks, pun intended, to sign up for its $98 a year Walmart Plus membership program. Insider Intelligence senior analyst Zach Stamborn notes that the announcement comes days after AAA reported that the national average for a gallon of regular gas rose 4 cents over the past week to $4.12, which is a staggering 43% increase year on year. As well as gas discounts, Walmart Plus offers other perks like free shipping for online orders and prescription drug discounts. But as of February, just 15% of US households had Walmart Plus. 62% of households have Amazon Prime, according to BizRate Insights and Insider Intelligence. So, Andrew, thinking about this tactic that might move the petrol or gas needle, another pun intended, with regards to Walmart Plus, I promise I'm done. With regards to Walmart Plus signups, Andrew, the performance of Walmart Plus thus far has been blank.
I think dramatically underrated. As you mentioned, 15%, it's maybe an unfair comparison to compare it to Prime, which is obviously really high penetration. Walmart Plus has come a long way. When we first started tracking adoption of it, it was at 6% just over a year ago. So it's come from 6% to 15% pretty quickly here. Got as high as 18% though in the holiday season. So they probably have some extra signups who take full advantage of the holiday season and then they churn because you do have more price sensitive consumers here. That's a big part of why I think the gas feature is so important because it's a way to make this subscription a lot stickier. I think the desire is really high. When they first introduced gas, it was always kind of a nice feature of a subscription program like this. But now it's very front and center, and I think it's going to drive a lot of people's decision making.
Yeah, and something that they've been paying attention to, Walmart noting that nearly all Walmart customers, 9 out of 10, were aware of rising gas prices. Nearly half of those shoppers changed their behaviors because of those increased costs. Notes, Zach.
Who are the 10% that are not aware of it?
People who don't drive. It has to be. Yeah, that's what I thought. Was like, where have you been living, and can I live there with you? Story 2. What is Target's strategy to compete with Amazon? Jason Ayton of Inc. recently wrote a piece about it. Amazon mostly sells things online. Target mostly sells things in stores. As a result, most of Amazon's 1.6 million employees work in fulfillment centers. Most of Target's employees work in their 2,000 stores. And so, Target is using its most valuable assets, its stores, those stores, and its people to serve its customers regardless of how they want to shop, Mr. Ayton writes. According to Target's 2021 full-year earnings, over 95% of all of its orders online and in-store were fulfilled by its stores. And why not? Since 3/4 of Americans live within 10 miles of a Target. Andrew, your biggest takeaway from Target's fulfillment strategy has been blank.
It's smart because Target is playing to its strength. People love the Target store. Curbside pickup, love it, right? Curbside pickup, when they introduced it, consumers absolutely love that. And they keep investing in it. Recently, I think in February, they announced that you can get Starbucks as part of curbside pickup. And people are like, that's brilliant. It's amazing. Wow. So, when you can inspire that much love for the customer experience and it all comes back to the store, especially at a time when the winds are, as we already mentioned, moving away from e-commerce a bit and back in the direction of physical stores, Target's very well positioned and they've executed on a very smart strategy.
So a colleague of ours, Lucy Cook, sent me a video recently. I think it was like a spoof video about how addictive Target is. And there was someone on the video saying, I go to Target and they tell me what I need. It's that addictive. Just show up. They'll tell me what I need. Don't think they won't. I just need to be there and they'll tell me all the things I need to buy when I'm there.
It's a weird thing, but I feel it too when I go there. And I mean, there are a few things that can get my kids excited to get off of their iPads. But if you say, do you want to go to Target with me? They jump at it.
Yeah. That's all we've got time for today's episode. Thank you, Andrew, for hanging out.
Thanks, Marcus.
And thanks to Victoria. She edits the show. Thanks to everyone listening in. We will see you tomorrow for the Behind the Numbers Daily, an eMarketer podcast made possible by mParticle.